Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. How are you on this Tuesday, the day after Memorial Day?
I'm fantastic.
Had a good Memorial.
How are you doing?
I'm well so far.
Yeah.
You know, as the day goes on, we'll see. But it's all good. Hopefully you had a great Memorial Day weekend. I know you, when we were talking offline, you said the camping trip got interrupted by a little weather threat, and understandable.
Yeah, I'm getting a little soft in my old age. And when they started talking about potential tornadoes and severe thunderstorms, I figured it was best for me not to be sitting in what I call a tin can during all of it. So,
well, as I said then, I thought about you, and we don't want you in a tin can when a tornado blows through either. So that's good. Get out of the camper, come home, and whereas you said there's a basement to go into if necessary.
Right. Precisely.
Likewise, but honoring those who gave all over Memorial Day weekend, and
that's right.
And then of course, everybody calls it, welcoming summer. And so I love that, because at least here in Loveland, in wonderful Cincinnati, Ohio, we welcome summer with falling temperatures. We're going to have a really beautiful spring week with highs in the 70s.
Yeah.
And just going to be nice.
I think the high today is what, 74? So
is that?
Yeah. So it's perfect weather. But no, it was a great weekend, and I'm always impressed. Even Loveland always seems to do a pretty good job on Memorial Day weekend and honoring people, and it's good. It's good that we remember what the holiday actually is about. I mean, don't get me wrong, I'm all about a good grill out and some swimming, but with a lot of holidays, you got to remember what they're all about. So.
What the cause is, but which we wanted you to make it through Memorial Day weekend, no matter what. But today, Taking Stock celebrates officially 1 full year of Taking Stock. So congratulations.
Isn't that amazing?
It is.
Thank you, and congratulations to you.
Well, ultimately I was going to say at least congratulations to us.
Yeah.
Somehow we pulled this off, and we've managed to gain some audience over the course of time compared to a year ago. So hopefully continue to move in the upward direction, which fits the narrative for the show, because we're hoping the market is trending upward as well. And anyway, so congratulations on a year, and let's talk about what's happening in the marketplace. That's what everybody's listening for, not our camping trips.
Well, again, someone might be. It's a lead-in, but thank you to you. I mean, without you, this whole thing isn't happening. Without you, we wouldn't be doing it. Wouldn't have done it for a year, and it's for me, it's been real positive. I mean, it helps me a lot. I mean, at least twice a week, we're doing a deep dive into some things, and it helps me a lot to put some of those things out there and sort things out in my head. But it also has, like you said, we're starting to pick up a pretty good number of listeners and things, and it also, we've received a good amount of really positive feedback. People seem to be enjoying it, and conversations like, I heard you say this, and that made me think about that, and
excellent,
and it's good. So, in the end, the goal is for me anyway, and I'm sure it's the same for you. The goal is to help people be better with their finances, or help them to understand things a little bit better. Because it's not, I've been doing it 37 years. It's starting to be a little bit second nature until they change some of the laws. But other people, it's like me. You don't want me to fix your car, right? You don't want me to touch. I
don't think so.
You don't want me to touch your car because I don't know anything about them. But it's at least if we can share some experience and some expertise and make things a little bit better for people, I'm quite pleased with that.
Well, if there's something as we get moving into episode 26 of Taking Stock today, likewise, I've learned a ton because this has not been my forte. As I've said over and over again right here on the show, is Sue should be sitting here, my lovely bride, who does understand the world of finance much better than I do. But I've come to learn, a lot more, with thanks to you and what you share. But if there's something, the goal, to start those conversations that you just mentioned that are being had where people say, hey, I heard this, and what about that? And then you have that conversation. Or even if they're having it with somebody else, hey, I heard this on taking stock, and what about that? If they're talking with their professional financial advisor or consultant or even their spouse on how should we be doing things and how can we do it better. We want that.
Sure.
If we're lacking anything for this show, which I think would contribute to the conversations ultimately, is folks that are listening, our friends who are listening right now, please do send us your questions. Send it to Art. Send it to me. Send it to my email. Yeah. You can find it on the lovelandbeacon.com. You can find out my contact information. I don't need to say it right here on the show, but lovelandbeacon.com will give you all the contact information you need. Send us your questions. We share this, each week or every other week when we put the show out. We share it on, the social media sites, Facebook, most importantly, even on the LinkedIn, where it gets a lot of attention. We appreciate the LinkedIn people chiming in. But send a question, even in the comments on the social media pages. Hey, here, I'd love it if you guys talked about this because I'm trying to figure out how to do that. So that's the one piece. The one main piece we're aiming for is to start those conversations and have answers within those conversations for you. But tell us what you want to know, as opposed to us sharing what we think you might want to know.
Yeah, you're exactly right. I mean, the last thing we want is this to become stale.
Right.
And so the best way to keep this moving forward is to get people's questions and find out what they really are concerned about. And, there's a right way to do things and there's a wrong way to do things, right? And, if you can skip some of the mistakes, it helps out a lot. But, if you're a young person, there's certain things you should be doing that will make a huge difference in your life down the road, And there's also, if you're someone that's getting ready to retire or something like that, there's a right way to do things and there's a wrong way to do things. And, if you do things the wrong way, you could be shortening your retirement. And, so you need to pay attention to some of those things. So, yeah.
Yeah, who among us wants to make our work life longer?
Yeah, well,
we're aiming for a longer retirement and a healthy, successful retirement, right. Financially, physically, mentally, all of that, which comes with being in a position financially to retire and be comfortable with those things that go toward your mind and body.
Right. The vast majority of people, but I will submit to you that there are a few people in this world, a very small percentage, that should not retire. Okay? Because they retire and...
My doctor, my dentist.
Right, exactly. Yeah, precisely. Yeah, because they retire and they don't have a plan.
Well, I know.
And the worst, and then that's bad for your health. That's bad for everything. So, but that's a small percentage of people, So.
Right. Well, that's the whole point, though. That percentage of people is who we really want to have conversations with to help them put themselves in a position to be able to retire in some way or at least, work part-time instead of full-time until the day they die or whatever the case may be. Not everybody's in a position, and it's a tough battle, but we're taking stock. Let's take stock. Let's ask you, whoever you are listening, to take stock of your life, your financial health, and come up with some answers.
There you go. Perfect.
And part of that is just knowing what's happening all around you every day, no matter what you've done. The economics are happening. We were talking offline, Art, about the, here we are. I said since the 1st of April, it's up and down every day.
Yeah. Very much so.
Today, I guess we were talking. So I heard the thing took a quick look, and the futures were, had the Dow Jones down and the S&P up and the NASDAQ up.
Right.
And you've got the red lights and the green lights flashing in front of you right now. So
they like to keep it simple.
Who's up and who's down?
It's the same thing as with the futures. Is Dow Jones is down about 0.4%, but the S&P's up very slightly. Up about 0.05% at this moment. But the interesting thing is the NASDAQ has come alive again, which is very highly technology driven. One of those big ones is what I'm calling today's darling of Wall Street, is that NVIDIA stock, which is the AI chip maker. It crossed over $1,000 a share last week, and we're already up above 1120. So it's on a little bit of a tear, and the NASDAQ reflects that. The NASDAQ the last few days in a row has been hitting new highs.
Well, there's potentially, and you may know more about this. I'm certain you do know more about this in general, but so the AI had a change in leadership. The main AI. I don't know if you're aware of that. So whoever the president and CEO.
Oh, right.
Yeah. See, I know you know it.
Yeah.
But I just wonder if that's helping drive the AI up again, where there's a comfort zone with the people they were concerned about decisions that were or were not being made.
Yeah.
And I think one of the things is the fear of the harm that can be done with AI. Mm-hmm. And there seems to be, in the last several days, something that AI is addressing safety protocols so that it won't be abused.
Yeah, you're exactly right. I mean, that I don't know the names of the people, but you're starting to see where there's an actual organization that's in charge of this, and you're starting to see more conferences on pros and cons and trying to evaluate if this happens, what's that look like, but we got to remember AI is a tool. Okay, artificial intelligence is a tool. The ink pen is a tool. The typewriter is a tool. The internet.
Typewriter.
It's just anyway, we'll talk about that later.
But keyboard on your computer.
Today,
For those of us who are still so young,
right.
We're into the computer. Typewriter.
Yeah, I know. It falls back with 8-track.
Okay, go ahead. Anyway.
Or the internet. So we talked about a lot of meetings talked about the internet and things and how to use it and the impact, and the internet is a marvelous tool, but it also has a very dark side to it, right?
Clearly.
Well, so the point that you actually have a group of people trying to sit down and come up with some policies, or trying to be a little more forward thinking about it, that's 100% a good thing, because let's be clear, it's not going away. All right, this is I remember internet when it first started coming out was a fad. Right. Well, guess what? It's not. And the AI is going to be the same way. And there's already bad things coming from it. The scammers are already using AI to make their emails look better and things like that and stuff. So there's that. But also, what is AI going to bring to the medical field and all kinds of things? So every single industry should be looking at how can AI improve what we're doing, whether it's all the way down here, whether it's education or whether it's some kind of manufacturing or whatever. So it's not going away, and that's why a stock like NVIDIA is doing so well, and I mean it is doing really well.
Right.
Is because they're the ones that are cranking out these chips that are heading into almost everything.
Right.
So,
today's wild, wild west. The AI.
A little bit, yeah. You're right, and there's always. We got this kind, and we got that kind, and we got this kind, and somewhere along the line we standardize things.
Right.
Remember Beta Vision? So that's where the VCR came from. Which no one even knows what a VCR is anymore. But yeah, it's that kind of stuff. But the point
Beta went to VHS, and now it's digital.
Well, everything's on my phone now, so I don't, right?
20 years ago, as recently as 20 years ago, we could not do what we're doing right now in terms of recording a episode of Taking Stock as a thing called a podcast. So
that's exactly right.
It's ever changing. What's going to be interesting, though, is as you were talking, sure, and every step of technology in our lifetimes, and we've been here for a few years,
couple few,
and though people have been around a couple decades, have seen technology leaps and bounds changing, and every level of technology has its, for some reason, bad guys are always going to find the way to abuse it, misuse it, or do some harm with it. What's going to be interesting is what AI is a tool that is developing into what's next. It's not the end. AI is not the end. Yeah. And where AI is right now is not the end of where AI is going. So it's going to be interesting to see. And so, that's, getting back to the point of taking stock, that's what drives its stock, right?
Oh, 100%. And that stock, we've talked about it, weighted indexes and unweighted indexes. NVIDIA is in the S&P 500, NVIDIA is in the NASDAQ. Well, NVIDIA is driving the NASDAQ. We're hitting new highs on a daily basis on it. We jumped above 17,000 here last week. Last week. So that's the driver. But again, AI will most certainly make our lives better, but it's also going to make our lives more complicated in some way, shape, or form, right? So, and it's a wave. And from an investing standpoint, it might be a little ahead of itself at the moment, but the growth rates are impressive, and it's not just NVIDIA. I mean, there's a whole lot of other things that have to do with AI and things like that that are going to benefit from it. It's interesting because right now we're kind of in a weird spot in the markets, or we're kind of stuck in the quicksand a little bit at the moment. There's not really any real good reason for the markets to jump up substantially more from where we are, because the earnings numbers aren't jumping up that much. Interest rates have kind of settled, so they're not going up, not going down. But also, there's no real good reason to go up, but there's not a really great solid reason for us to have a substantial drop. And I guess it was last week, I think we lost 1% one day. We lost like 600 points on the Dow Jones, and the next day we made it right back. Right. And that is clearly, that's the market just trying to figure out what to do with itself. And right now, some days, you just don't do anything, right? Just leave it be. Because we're looking for new information to give us a reason to do something, right? Yeah. And the one thing is again, the NASDAQ and the capitalization weighted indexes, they're doing really well because of the technology. It's being driven by technology. When you look at the S&P 500 right now, in the last 12 months, is up 26%. But if you look at the unweighted index, it's only up 19 or something like that. So there is a gap between what's happening on average and what's being driven by technology. So hopefully, being long-winded here, but hopefully, what's going to happen is some of these stocks that have been neglected, some of these industries and some of these sectors that have been neglected, we'll start to see some money maybe shift out of the technology-driven stocks and start to move down to, in my opinion, would be more still to some growthy type stocks, so consumer cyclicals or something along those lines. Huh. Yeah. But we'll see what it is.
You say like I love that, growthy. Mm-hmm. Stocks that have room for growth, that are and then consumer cyclical.
Sure.
So tell our listeners, in your words, the definition of consumer cyclical stocks.
Yeah. So if I was going to compare and contrast, let's say you have consumer cyclicals and you would have consumer staples.
Okay.
So consumer staple would be like your Procter & Gamble of the world, your dish soap, your toothpaste, your
I got you.
bounce fabric softener and things like that. Things that generally don't have a high growth rate. They do have higher dividends, but they're a little more smooth. They don't have as big of jumps up and down and things like that because they've become much more of a mature industry compared to a consumer cyclical, which would be cars and things like that. Washers and dryers and things like that. They're a little more. They're driven a little bit more by how's the economy doing and things like that. They're more of a, if things are going really bad, you're probably not going to go out and buy that brand new car, right? So that's more of a cyclical. And they typically have higher growth rates. They also typically have lower dividend yields and things like that. They also typically have a little bit more volatility. So, like if I took the S&P 500, took 500 stocks, split it down the middle, and said, okay, these are growth stocks and these are value stocks, and we've already shown that since 1950 something that the S&P 500 has done 10.26% per year on average, but that's the average. The growthy stocks have probably, let's just say, they've done more like 12% per year, and the value stocks have done more like 8% per year. Okay, so. So and then there's other sectors. You got real estate, you got technology, you have telecommunications, you got oil and financials and all those kind of things. There's a lot more areas to go play.
We're going to have to make it a point in a future episode to talk a little bit about those like with the oil, just because oil tends to be I guess I'd call it the energy stocks. I don't know if that's right or wrong.
The Chevron and Exxon, they all fall under there. Yeah.
So it should be interesting because that's a changing industry too, with what almost a mandate to get more green. So that should be a conversation we have to have in the future. Talk about that.
Yeah.
But I think what you just did, certainly for me, and I think for a lot of the listeners that hear this, understanding the difference, between I'd say the daily, consumer stocks versus the maybe the big purchase, like you said, the car versus the appliances. We all try to hold off. And say, I don't want to have to buy that. I don't want to have to buy that new whatever it is, whether it's washer, dryer, or even your HVAC system or your car needs to be replaced. We're all trying to keep those things maintained and running, and find the right time. So,
exactly right.
If technology is being driven, the NASDAQ is driven by the technology stuff right now, and your hope is to see some of that investor money go back into the cyclicals.
Yeah, because my client, I'm not running a 100% technology-driven portfolio for my clients, right? I mean, they have many of those sectors I just mentioned, and there's some international, and there's a little bit of value, but there's more growth and things. I would like to see where there's a broader participation in the market, because that means the portfolios are going to do better. I'm not, most of my clients don't want 100% technology portfolio because it bounces around all over. NVIDIA back in, March, NVIDIA dropped 30% in 1 week. Yeah, my clients' portfolios don't drop 30% in 1 week, right?
I think there was a lesson going back, and you could probably say the exact year, but like the .com bomb.
Bomb, yeah, exactly.
Versus the .com boom. So I think that's why, like you said, your clients, any clients, me as an investor, aiming for a comfortable retirement, don't want all. Number one, that's that old say, you don't want all your eggs in one basket anyway.
Right.
But like technology is exciting and it's moving, but I don't want everything in technology because we don't want to go through another .com bust.
Right. And it's not only it's technology, or we live in Cincinnati, Ohio. It's all Procter and Gamble, General Electric, right? Procter and Gamble, everyone, people retire from there and they're married to that stock, right? It's like pulling in, they think, oh, it's just done so well for me. But the fact of the matter, yes, it has done well, and it's done well for people, but at the same time, it has underperformed the S&P 500. Yeah. Okay, so that's why we run a diversified portfolio, and and the thing is some people look at this as like, I'm either in the market or I'm out of the market. right? Well, that's not the decision. There's a whole lot of gray area.
There's a lot of variables within the market.
So many, right? I mean, if we want to get more conservative, that doesn't mean we have to get out of the market. Maybe we move a little bit more to the value sector, or value portion, or maybe we go international, or we get out of the consumer cyclicals and move toward the consumer staples and things like that. So there's a lot that goes into it as always, but people tend, a lot of market timing going on, and people are like, okay, I'm out, right? Well, that's usually not a good thing, and that's been proven here over the last 12 months.
Well, we are coming up on the end of our 1-year anniversary show, and I'm going to say this again. We need to talk about energy in an upcoming show. And then the other thing you just touched on a little bit was international stocks.
Sure.
And what that means and how that impacts, what's happening in our economy and what happens in your clients and investors' portfolios all over. But as we're wrapping up here in the final 2 minutes, so you also touched on, the people who retire from P&G and they're married to that P&G stock. I'm guessing that you've had a couple of those clients.
Yeah, one or two.
Yeah. Well, without naming names or anything. So how much success have you had pointing out to them, the value of diversity over just that P&G that got them, that got them through and got them out into the retirement world? I mean, how's that?
Great success.
Yeah.
And it's not you're in Procter & Gamble today and you're out tomorrow.
Right.
It's a process because, number one, you got to watch out for capital gains taxes and things like that. Yeah. So it's a process. But let's say I'm in Procter & Gamble's in the 160s or whatever right now. And, the stock all of a sudden jumps up into the 170s and gets a little top heavy. Well, then we take a little bit off the table, right? And,
sure.
And move it into something else and just kind of start a more of a diversification process. Yeah. But things like I showed you, I sat down and said, here's how it's done in 5 years, 10 years, 20 years, 25 years, and 30 years. And every single one, especially longer term, P&G has underperformed the S&P 500. Now, don't get me wrong. It's done well, okay?
Oh, for sure. It's not like you're trying to get them out of it 100% even. No. It's part of the portfolio.
Yeah, I mean, we've seen multiple times. I mean, let's say Procter & Gamble, and the year's going to escape me, but let's say it was early 2000s or late 99. Procter & Gamble dropped 50%.
Yeah.
Okay, and then there's some stories in there that's too long for the show, but people were planning on retiring, and then they weren't planning on retiring because it dropped it. Now it came back and it's done well, but I don't care what company it is. Your entire life should not be based on one company or one stock.
Excellent. As we know, energy, international, and the questions that come in between now and 2 weeks from now from our listeners who heard us say, or are hearing me say again right now, hey, send us your questions, open up the conversation that we want to have with you, that Art Jarvis, Professor Jarvis, he had the teaching, you had the professor's cap on a minute ago, because, and I forced that issue with saying, hey, how do you have success getting somebody that's married to a particular stock? We used Procter & Gamble as the example, but that's the professor, that's the teacher.
No one ever accused me of being a professor.
Well, that's the teacher part of your business, I believe. So, Art.
Okay. Happy anniversary.
Happy anniversary to us, to Taking Stock. Episode number 26 is wrapping up right now. Thank you so much.
Yeah, thank you very much. And again, I appreciate everything you do. Thank you.
You bet. Until next time, that is Taking Stock number 26. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.